name is Rainer Ries, and I'm the Director General of FESE, and very much welcome this morning to the joint webinar from Better Finance and FESE on enhancing retail participation in capital markets through pension products. This is part of the European Retirement Week, which I think is its third edition. And all of you know that retail participation in capital markets obviously can have numerous benefits for European citizens. The long-term returns on retail investment can help to increase household wealth and also support retail investors with their long-term financial planning. Such as, for example, and that's a bit the topic we want to discuss today, the saving for retirement, in addition to the classical state pension systems, where we all know that there is a growing pension gap and that capital investment will be needed to ensure decent retirement levels. The aim of the webinar is really to address the question of how we could enhance retail participation in capital markets through pension products. And it is a great pleasure for me to welcome Alexander Schröder, Deputy Director General of DG Financial Stability, Financial Services and Capital Market Union from the European Commission, to deliver a keynote. Alexander, the floor is yours.
And thank you very much, and a very good morning to all of you. And let me start by thanking FESE and Better Finance for organizing this webinar. And you know, it is a good tradition to hold during the last week of November the European Retirement Week. And in this important context, you have chosen a very topical issue: how to enhance retail participation in the EU's capital market through pension products. Ladies and gentlemen, we all know it. Europe's population is continuing to grow older. We're having fewer children, and the working age population is decreasing. It is a bit unbelievable, but by 2050, there will be close to 500,000 centenarians in the European Union. And this combination of circumstances is often referred to as the pensions time bomb, if you would like to use such an expression, due to the pressures and the real pressures it will place on public pension schemes. The consequences of not making sufficient provision for retirement can be very serious. Already today, we can see a trend towards increasing poverty in old age, in particular, but not only among women. The overall percentage currently stands at an EU average of 18.5%. So it is never too soon, including our younger generations, for whom it may seem a distant prospect, to think carefully about how they can accumulate enough savings to cover their retirement needs as a supplement to dwindling state pensions. I would like to kick off today's discussion on how retail investor participation in capital markets can play which role in the context of long-term retirement. And I'm pretty sure every participant in our seminar today is aware about the retail investment strategy, the proposals the European Commission put forward this year on 24th May, a comprehensive package of different measures that we call the retail investment strategy. And we believe that the most effective approach to enhancing participation of retail investors in capital markets is to put in place a robust, ambitious, and also a transparency regulatory framework. And its rules need to empower retail investors to undertake investments while at the same time being adequately protected. And the framework should in particular entail facilitating investments in products that are suitable for long-term investment strategies, as I was just explaining. More retail investment is good for the investors themselves, but it's also good for our capital markets, because it is at the same time a driver for prosperity, because those savings can be put to use efficiently and reinvested into businesses to the benefit of the broader European economy. Let me start to explain a little bit more what is exactly the problem today with retail investment in Europe. And indeed, at the moment, regrettably, retail investment participation in the EU is low, too low when compared with international standards, and quite worrying when we look towards the longer term. Just 17% of EU household assets are held in financial securities. Too many consumers in the European Union have a rather poor understanding of the investment environment. Levels of financial literacy are quite low, very low sometimes, with many citizens struggling to understand principles of finance and often indeed very complex financial products. And this is an important factor limiting the growth of the retail investment market. So retail investors today are heavily reliant on advice they receive from intermediaries. However, evidence also points to rather low trust levels retail investors have in their advisors, and that is, of course, very regrettable. Basically, 45% of Europeans are not confident that the advice they receive is actually in their best interest. And at the same time, often investment products that are available to retail investors tend to be quite expensive. Not all, but there are products on the market, and especially when we speak about more complex structured products that carry really high costs, and in the end, they eat into net returns. So it is hardly surprising that many EU citizens prefer to leave their capital in the bank or deposit accounts with no return on investment, including their pension retirement age. So how do we as the European Commission want to address this serious issue? And you have certainly already heard about a number of elements we have put in our strategy to accompany investors along their journey to invest their capital into solid and products that will cater once they reach their retirement age. I don't want to speak to all of them because there are quite a number of different measures, but let me concentrate on three big topics to also kick off the discussion today in the webinar. And I would like to start with transparency, because transparency for us is a very important element. And honestly, today we are not there where we should be. The positive message, in my view, is that if you speak to all different stakeholders, everybody agrees that we need to have more transparency about products for retail investors. And therefore, our proposal includes a range of different transparency rules, including, and that is particularly important for us, transparency of cost disclosures. And of course, we have also taken into account the need to address that we are living in a digital age. And in the context of a more and more becoming digital environment, it is also important, and that is another element in our disclosure regime, that we are addressing new types of marketing activity. And here our aim is to ensure that marketing communications, and of course there are a lot of them, are clear, are fair, not misleading, regardless of the channel through which they are distributed, and irrespective of whether they are communicated directly by investment firms. But of course, we also have today a number of medias, persons, we call them influencers or finfluencers, that actually receive quite a high level of trust. You know, I spoke about the need of younger generations to start early to invest for future pensions. And therefore, it's particularly important to ensure that our rules suit younger generations of investors. Certainly, they tend to be a bit more tech savvy than other older generations, but at the same time, they may be less experienced and possibly more exposed to risky investments, and they may be pushed by misleading marketing campaigns. So this is something we are addressing in our proposal, in our strategy. No speech about retail investments without the issue of inducements. And let me therefore explain a bit what we have done and where we stand. First of all, I think it is still important to repeat that in our analysis, we have come to the conclusion that the way investment products are designed and distributed today in Europe bears really potential conflicts of interest arising from the payment of commissions by product manufacturers to distributors. And that is a serious issue we need to address. Again, higher transparency about the production distribution chain and its cost is inevitable. And there is, of course, the question about a prohibition of inducements. And as you know, for now, the Commission decided not to propose such a full ban, but we have instead opted for a staged approach, introducing first a set of restrictions and safeguards in relation to advice. We have, however, proposed a partial ban for what we call execution-only sales of products, because even where no advice is provided, the payment of inducements can still lead to higher cost for retail investors and a more prominent promotion of induced products. The proposal also makes the obvious clearer and more stringent. Firms must act in their clients' best interest. And we have a new best interest test that sets concrete criteria to be followed to ensure that investors do act in the best interest of the client. What we intend to do is to monitor very, very closely how the situation develops. In any case, we will have another look and evaluate the situation some years, and we have proposed 3 years after the hopefully final adoption of the strategy. Let me come to my third point that is equally important, and we call it value for money. And here we want to address that we have evidence that some products sold to retail investors provide little, if any, value to the retail client, in particular due to high costs of products. And IOPA and ESMA have been working on this since long and intensively, but we think we need to do more and we need to legislate. And therefore, we have a value for money assessment in our proposal that builds on and enhances existing product governance requirements. And what we have in mind, very briefly, is that manufacturers and distributors will need to assess costs and performance and to compare their product against a relevant benchmark of a similar product, if this is available. And those benchmarks would be developed again by ESMA or IOPA, who have really very good experience in this matter. There is sometimes the perception or the concern that value for money is only about costs. But I would like to be very clear to you today that the concept does not look at costs alone, but that costs are assessed in view of the characteristics, objectives, the strategy of the financial instrument, and also its performance. So, ladies and gentlemen, that were in a few minutes the big tickets of our retail investment strategy. I have tried to explain it because, in our view, the retail investment strategy will bring a lot of impetus to our problem, how we address the pension gap in Europe. We are convinced that by strengthening this EU investor protection framework, we will make a difference, providing citizens with the means, the knowledge, and the confidence to invest more in capital markets. And maybe to cut it short within one sentence, we can help them to help themselves provide for their future needs. Our proposal, as many of you will know, is currently negotiated by the Parliament and the Council. There are many stakeholders commenting on our proposal, and it's also correct they are commenting it from very different perspectives. I trust, however, that we all share the overarching goal to increase retail investor participation. And to achieve that, again, I have to say we need to change the gear. This is our duty for the benefit of future generations, and we cannot afford to lose. So I count on your support to push for an ambitious outcome of the negotiations that in the end will really bring meaningful change. And with that, I thank you for your attention. I wish you a good webinar, and I look forward to a certainly interesting discussion.
Well, thank you very much, Alexandra. And I think your outline of the three cornerstones, I think, was very helpful to frame the debate. I mean, sort of for what sticks for me very much is really the points you mentioned at the end: trust, transparency, being I think establishing clear, fair, and not misleading markets, and also obviously what value the saver receives is extremely important, and that is a big debate I'm pretty sure we're going to have on the panel. But even more, I think what you said in the beginning around savings being put to use and making capital markets union work, I think that is for me probably the biggest thing we need to achieve as European Union. If I look at the lack of capital mobilization, that really EU savings, and especially also from pensions, are mostly channeled in not into equity, but rather into fixed income, with some examples, and we probably will discuss Sweden today as an example. The PEP not really having the success we all would have hoped for, solvency rules still making it difficult for pensions to flow into equity, and thus really acting as a catalyst to provide the financing also needed for the sustainable and digital transition, and ultimately for growth and innovation in European enterprises. I think that is, and I would very much agree with you, something we would hope the retail investment strategy can play a big part in playing in building really a capital market union. So thank you very much for this. And I think what I outlined are pretty much the things we will be discussing on our panel. And so I would switch to the panel, and thank you very much, Alexandra, for your time this morning. First of all, I would ask the panelists maybe to put their cameras on. And first of all, I need to excuse Antonios Manders, member of the European Parliament. He wanted to attend, but unfortunately he's busy in the Parliament this morning due to an unforeseen meeting. He called me late last night to tell me that he cannot attend, and he asked me to pass his greetings, and that he thinks the topic of pensions and securing and entitlement really, especially he's Dutch and obviously very much concerned with the Dutch system, and said that pensions being paid into Pillar 2 are basically deferred salaries, and he has a concern with some recent changes in the Dutch pension system, as well as the lack of indexation, which he thinks will disenfranchise pensioners partially in the Netherlands. So he asked me to pass that message on, and possibly we'll touch on that. But let me briefly introduce our panelists here today. So we have Brian Coughlin, he's Senior Finance Officer with Berk. We have Nikolai Kosakiewicz, Senior Vice President, President of Nasdaq Copenhagen. We have Alexandra Machinskaya, who is Acting Managing Director of Better Finance. And last but not least, Jan Chebo, Senior Researcher of Machabell University and their Faculty of Economics and Head of Research at Orsansoka Obalka. I hope I pronounced that correctly. And
in English, it's orange envelope. Thank you.
Okay. So I think we heard a bit what Alexandra said about the retail investment strategy, and I probably would start with you, Alexandra, to maybe tell us a little bit. In the first round, I would ask everybody, what do they think about the proposal? We heard the controversial topic of inducements, but I mean, something risk is going too far. Some say it is not going far enough, and it is not ambitious enough. So, Alexandra, where do you stand?
Yes, thank you. Indeed, Alexandra already mentioned many important points that consider risks. First, I would really like to say that risk, in our opinions and Better Finance opinion, is a very good step forward, definitely. And the elements that are inside and whether it's ambitious enough or not really depended to a certain extent on the political climate that surrounded the discussion before the publication of this proposal. And I think most of the participants of the webinar are also aware of the enormous pushback, even before the proposal was published, to not include in the proposal itself some of the solutions that the impact assessment of the Commission found as the most efficient ones to tackle many problems we have right now in the market of retail investments, such as conflicts of interest. But we still think that the elements that the Commission has proposed, and they are still there on the table, are quite important. And if implemented in a right way, they could still make a difference. And we really think that the retail investment strategy is the sort of really right once in a lifetime opportunity to change the situation for retail investors in the EU, which is not good. Many problems were highlighted already by Alexandra, such as the trust in financial products, but most of all in financial advisors. And for Better Finance, really the biggest problem right now on this market is the problem with the trust in financial advisors. So we have been saying for years that investing is not a full-time job, and that the retail investors in the EU should be able to rely on financial advisors, investment advisors, that they are really advising in their best interest. The system we have in place right now, the mostly commission-based system, is really not working well, because we really think that the incentives are not put in the right places. And then most of the time, and it's not only what we think, but finance, whatever recommendations we are putting forward, we are basing this on research, either our own independent research or the studies that we are aware of, like the studies that were done also for the European Commission. So the situation is that the investors nowadays mostly turn to advisors who are based, who are working in this commission-based model, where first of all, they are paying already for this trading commissions throughout the years. So this is quite expensive. So it's driving the cost for them of the retail products. And then the commissions are changing the perspective, of course, of the seller who is selling the product, because they then not always are advising the products that would actually make the best returns for the consumer. And we see this in our annual research on the real returns of the pensions and long-term investment products. We are going to publish the research on Thursday, and also Thursday we will be talking more about Dutch system. We will be talking about the Swedish system. So whoever is interested, please also join us on Thursday. So I think that the proposal concerning value for money, this element is quite important. I have heard a lot in the recent months from the stakeholders, mostly from the industry side, that it's too much focused on cost. I don't agree. Cost is important element and a very important factor for consumers. And as many say, if you want to have the least risky strategy to improve your returns, you have to start paying less to the financial industry. And I think it makes sense. But of course, you have to look also at the risk profile of the investors, the investment objective, but altogether cost and performance is also tackled by the value for money proposed by the Commission. It's a very good element, and I really hope it's going to be kept in the proposal to really make it meaningful and make a change for consumers. But in this vein, I also wanted to mention a study that has been done in 2023 in Poland. The study that was supposed to measure the level of financial knowledge of Poles. And in fact, when Poles were asked about their knowledge about investing and saving for retirement specifically, they were aware about the products that are on the market in which they can save. But still, 78% of the respondents, so almost 80% of the respondents, said they have no intention to start right now saving and investing for the retirement. So this is really very bad. Only like 11% are investing right now in the products available for them on the market. And so even the awareness is not making things better for them, because they are a bit afraid, of course, of the risk, and they are not really sure if this is the right way for them really to to take care of their retirement. And we really think that part of the problem is that they don't have enough independent advisors. They don't know whom to really turn to get a really good advice on what they should do for the retirement. So I think every time that we talk about investing in the EU and making people move their savings from their banking accounts to invest, I think every single time it brings us back to the point of the good independent advice. So for us, really, this is the most important element of the proposal, and therefore we are also supporting this very limited ban on execution only in the proposal. So maybe as an opening remarks, I would stop here.
Perfect. Well, maybe I would go to Jan next to hear a bit the academic perspective, and then Brian to also give the consumer side, and Nikolai, I'll come to you last.
Thank you kindly for the possibility to share some of the research experiences regarding the pensions. Well, I've been active in research of pensions and pension products or long-term savings products for more than 20 years. However, when I look back at the amount of research we have done, I have to confirm that the young generation or young people actually do not share any kind of interest in long-term products. They are aware of some deficiencies of typical pay-as-you-go pillar schemes. However, they do not consider it's really important at that moment. The moment when they start considering their future, especially their retirement, is the moment they set up their families or when they have the first or second child. This is the moment when they really start not only thinking about it, but also taking actions. There is one huge problem with this kind of behavior is you already skipped more than 10 years of savings and you are not able to catch the person who start saving in his or her early 20s. So basically, this is the initial problem. So from the perspective of users and from the perspective of regulators, we are talking about changing the perspective of users and how they think about, and this is very important, long run. We want them to run the marathon, but we have equipped them with the flip-flops. So this is the main problem we now see in the regulation. Basically, we provide them with not enough equipment. Do we understand the questions the savers are asking when considering running a marathon? They are asking, will I be okay when I retire? Do we provide them this kind of information? No. Well, we are trying, IRP, we do have pension benefit statement. Most of the countries do work on this kind of pension benefit statements that partially allow answering the question, when you retire, this is how much you can basically expect. Okay, this is key equipment. The second question most of the people do ask is, am I okay right now? Am I on track? Meaning, do I have enough savings? Do I have a right strategy? Do I pay the right costs for the product that will certainly get me there? And this is where we start asking questions about how we measure, what kind of measurement we provide on these equipment, these long-term products. And this is where we should start really serious research. And I'm really glad that for certain products, we already try to implement a different kind of measurement, because we do not focus on the short-term indicators like volatility. I don't care about the short-term volatility. I would care about the short-term volatility if I would be running 100 meters, because I need to be really fast and really constant. But when I'm taking the marathon, there are certain passages where I need a rest. There are certain passages I need to increase my speed. and the short-term measurement of volatility is basically not really the right measure. So we need to measure it in the long term, and we need to answer these kind of questions. And for the, as I have mentioned several times, for the PEP products, we have introduced this indicator. Let's call them indicator of the safety, and it's not about the guarantees, because it's, you know, guarantees always shifting the risk to somebody else, and you need to pay a huge amount of money for that. So basically, the safety is about the probability of, you know, achieving the goal, and in this particular way, it's the probability of beating the inflation at the very end. So basically, I'm sure that when I'm saving in this kind of product, I will be safe at the very end. This is just one example, and I think, you know, there will be more discussion about even these technical issues. So I'm glad to, you know, contribute further.
Oh, thank you very much, Brian. How are your flip-flops this morning?
Yeah, so I like the flip-flop metaphor, but let me start in the beginning. So I was asked at a similar event to liken what I think of the retail investment strategy to a train on tracks. Would it go the right direction, and so forth? I thought that was actually an interesting exercise. I believe I said something like, the train is leaving late, it's going slow, it's probably going to stop one stop short, but it's going in the right direction. Which anybody who has recently tried to go by train anywhere will probably say is a fairly decent score around here anyway. The retail investment strategy is the first major attempt at genuine progress and fixing the systematic dysfunction of retail investment markets in the European Union. Obviously, like Better Finance, Beorg also believes that a full ban on inducements is ultimately necessary to create a market, to create competition for product quality, because consumers need to have some way to select the product that is best for them, instead of having the product that is best for the industry selected for them by an industry agent. Short of that, there are good measures in there that have already been mentioned. So we think that the value for money system will help mitigate the damage of the current misfunction. I am particularly a fan of the review clause, because it allows us to make this a process instead of an event. So we will not turn this market around suddenly, but if we maintain the strong review clause as is in the Commission's proposal, maybe even a bit stronger, then we can undertake this as a journey and continue improving the market, raising data, having the argument until we get there. And while that will include, any good result must include in the end a ban on inducements, that is not all. There will be other things that come up, and I'm looking forward to discovering them. I hope, therefore, that we can get this proposal fairly undamaged through the political process, and we will see. In terms of market situation and consumers, so bad products are the key problem, right? And bad products reduce pension savings in two ways. They disable a large portion of the consumer base, of the population base, from saving enough to clear the poverty hurdle in retirement. This is already a problem. Half the population can't save at all. And if products are poor, it requires greater savings to match the required outcome, because investment is about exponential growth. You have no real exponential growth. You need to put more and more money behind it. And that doesn't work, because it excludes more and more parts of the population who don't have that kind of money. And then the second part is, of course, that people look at this and say, this is ridiculous. I can have a good life now, or I can try to do this and still probably fail. And it creates an environment and a culture of distrust, which is also what we're seeing and which is what creating this disengagement that we've heard of today. So increasing product quality, both which is net returns by risk is important, and then more targeted products. So as we've heard today, and I would fully support this, trend is vital, not volatility. So you need a good outcome by the end of a savings process, 30, 40 years from now, right? I don't care what it does in the meantime. I just need to get to as high as possible in the end. And so I do believe we need to get away from fixed outcome results, outcome products. And then finally, we've heard a lot about financial education for consumers. And obviously, financial education is always nice. All education is always nice. But let me give you an idea, right? We all know that healthcare is important also, right? And we all know that eating healthy and having an apple a day would probably be good for us. But if I fall down the stairs and I break my leg and I'm at the bottom of the stairwell bleeding, an apple won't do me much good. I will need a bit more of a targeted medical intervention, right? And financial education will be good for us collectively, but we need to fix market structures to improve outcomes. For financial education, financial advisors are the first who need education. Currently, they are trained salespeople. They don't have much training in finance at all. Once we have financial professionals who can give advice, that is one of the primary vectors through which we can increase financial education in the general population, because then there are people you can ask. Then there are people whose job it is to give advice. And that is how we will increase the general level of education. And I'm looking forward also to working towards that. And I'll stop here.
Get the quality of advice up. No, I think that brings me to Nikolai. And I mean, if I listen to the three of you, I think the tone is a little bit all similar, that you think risk is going in the right direction, but the flip-flops need to be made to be shoes, or the train needs to be certainly on track, but go in the right direction, ideally with more speed, whatever metaphor we use. If I look to you, Nikolai, in the Nordics, you live a little bit in a land where you already have a fairly punctual train system, and you have good running shoes. At least when I look to Sweden, or I think Finland is trying to do similar things. Denmark is trying to do similar things. Maybe you give us a short view on the retail investment strategy from your view, but also maybe already entering our second round. I mean, would be really interesting if you could elaborate a bit on the Swedish experience, and what is different in the Nordics, and what is maybe what we can learn.
Yeah, sure. Thanks very much. Well, I think I want to go back first to what Jan Sebo said with the use of the marathon analogy, and point to the same Eurobarometer finding that Alexandra did in the beginning, with the first question being, do you feel that you have enough financial surplus to invest? And the respondents actually said that 47% of the respondents felt they didn't have enough funds to invest. So to continue the analogy, are you even able to run a marathon without legs? It's not only a matter of flip-flops, you need legs first. And then it's kind of a luxury problem for me to sit here and discuss the effectiveness or ineffectiveness of the retail investment strategy. I mean, we strongly support that we should modernize the disclosure practices, and obviously we also strongly support adjusting the eligibility criteria for professional investors. But I think mainly what we focus on is the ban on inducements for execution-only services when no advice is provided. And this is because, and it's important here for me to stress that there are local variations, or the Nordic region is not one region. It's very much local structures. To Southern Europe, it might seem like the pension system is very much alike across the Nordic region, except it is not. The banks still induce, the banks still promote their own products predominantly with, like Brian said, predominantly sales and not that much advice. And that is a structural problem. So I strongly support the idea of inducement ban if no advice is given. And I think we also need to take a step back and try to figure out why is it that people are investing, or not deliberately investing, but are allocating their funds more towards cash deposits versus securities in general in Europe versus what they are in the US. So if you look at the US retail investor and the average US family, people are used to saving individually to their retirement plans because they know that the government per se is not gonna bail them out. They also understand, because of the educational structure in the US, that you have to save for your kids' college educations. So people are used to the whole saving, and they understand that there is value in investing, in not just allocating your assets into passive strategies, not in the sense of ETFs versus actively managed funds, but actually taking a decision on where your funds are allocated outside of just cash allocation. So we took this decision across the Nordic region in the late 90s, early 2000s, that we wanted to make sure that we could fund the baby boomers, the millennials, and also Gen Z or Gen Z. And I think in general, the pension plans or the pension schemes across the Nordics are working really well. And if I'm allowed to double click a little bit on why it works so well in Sweden, the whole question of whether you have legs is something that is super important. And obviously, when you have the Swedish pension system, where you have a pillar 1, a pillar 2, and a pillar 3, where pillar 1 is by far the biggest one, it actually constitutes 54% of your planned retirement assets. Once you're set to retire, 54% of your assets come from pillar 1. Most of those investments go directly into public markets, and almost 50% of those pillar 1 investments, which maybe I should just take a step back and explain that that's approximately 15% of all your pension savings. Out of the 18%, 15 percentage points of that goes into both the premium and the income-based pension scheme under pillar 1. And as I said, almost 50% of that goes into equity markets. Those could be global markets. They could also be very much favored towards the local equity market. And because you have some flexibility in where the assets are allocated via the use of unit-linked products, obviously, when you get your first job and you start working, and 18% of your gross salary actually goes into a pension plan, you're kind of reminded that you are in control of your future retirement benefits. And when you're reminded of such a large deposit into your pension plan, you also want to make sure that you understand exactly what your opportunities are and where you should aim to invest. And this is why the flexibility of the unit-linked system and the fact that you can choose to go by the default fund, i.e. Some of it goes into the AP systems, AP1, AP2, AP3, AP4, and also AP7. And
what is APA? Maybe briefly explain.
Yes. So for the first 15% or the first 15% percentage point of your pension savings, those goes into the buffer group, AP1 through 4. And 2.5 percentage point of the 18% goes into the premium pension, where the default feeder fund, if you will, is the AP7. So the first 15% goes into AP 1, 2, 3, 4, and the last 2.5% goes into AP7. And AP7 predominantly, and this is why it's so impactful for the local ecosystem, the default fund is AP7, where all of your funds are invested in global equities up until the age of 55. Then gradually over approximately a 10-year period, that allocation declines into being 35% equity and then the remaining into fixed income, because you don't want to run too much of a risk the closer you come to retirement. And then on the income-based pension, i.e. the 15 percentage points, the asset allocation is roughly 50% into equities as well. So you can see that from a risk perspective, and I'm not going to be a judge here to say that this is good from a portfolio theory perspective, but it just goes to show that assets are allocated to both equities, which over the long run, over a 50-year period, will probably outperform fixed income assets or interest-bearing assets in general. But also approximately 10 to 18% of those assets under both the income-based and the premium-based products are allocated towards the local equity markets. Now, that becomes a little bit of a flywheel effect, if you will. If people start saving early for their retirement, they understand that a really good asset class to invest in for the long run is in equities, and you have the support for the local ecosystem as well, which means that you are allocating quite a lot to the local ecosystem or to the local equity markets. You are also offering the local investors opportunity to invest, as an example, in SME funds. And you, on top of that, educate the electorate, if you will, on financial literacy. Then you get this perfect flywheel effect, or a Pygmalion effect, where all of a sudden people do not only take an interest in their public pensions, they also take an interest in their Pillar 2 pensions, which is the occupational pensions, also paid by employers under collective bargaining agreements. And then in Pillar 3, which are your private pensions or private savings, if you will. Those savings are not necessarily aimed at retirement. And in Pillar 3, Sweden has a very unique tax wrapper called the ISK, which is very widely used. More than 50% of the Swedish population has an ISK account, an investment savings account, which is very easy to maintain. There is no taxation on actual returns. You just pay a fairly flat taxation on the actual deposit. So it's very easy to maintain. You know exactly that this is going to be treated like a debit interest rate on your account, and it allows you to invest without paying any attention to tax structures as such. Then you have sort of the perfect ecosystem across the entire pension experience. And what does that result in? Well, it results in a very strong equity culture with low thresholds for retail investors in general to be active in the equity markets. It also results, or one of the byproducts is obviously that tax policies encourage equity investments. It results in high public confidence in capital markets in general. And in general, it also results, it also bears fruits in the sense that entrepreneurial and innovators or startups, they have access to risk capital, because you have these SME funds that support both the growth markets, but also the SME, the SME segments on the primary exchanges. So the whole, both the support from the retail community, but also support from the pension funds with focus on SMEs, kind of creates the perfect platform for IPOs, which is why Sweden has been leading all the tables or all the leagues when it comes to the number of IPOs across Europe. And I think if you base it on a per capita basis, they're probably also leading the league on the international scene. So that was a little bit about the Swedish pension system, and Denmark has a similar kind of system, but it's more tilted towards the occupational, i.e. Pillar 2, and the same thing for Finland. So I would say that the Swedish model is definitely something that should be replicated across the European region, and it results in high confidence in your own high confidence in public markets, and it generates really strong returns and a sense of safety.
I mean, you gave probably a great demonstration of the Nordic systems, and I have to say it was extremely clear and very enlightening for me. And I have to say it answers also a lot of the points Alexander raised, how to put savings to use in a capital market union sense, and especially to also support the local economy, how to instill trust and financial literacy, and how to give value in the long run to sort of beat inflation and ride the trend, as I think Brian and Jan have been saying. Maybe to the other three bit reactions. I mean, there's a lot of, and I thought, this was really extremely enlightening what member states can do in terms of investor culture, in terms of national approaches, and maybe starting with Brian this time. What would you sort of like to see on the national level? Because of course, this is one thing. Sweden shows member states can already do a lot, and what is sort of what we would want to see from member states who are also not, well, how should I phrase that? Maybe not all embracing risk with open arms. So, Brian.
Yes, so member states in general have two categories of options of what they can do, right? They can act on the European stage in the Council, and they can act by themselves. I'll just brief aside. So not blocking progress on the European stage would already be quite helpful, and looking particularly at Germany here, but also at other member states that not torpedoing considerations that came up in the RIS would already be a contribution. On the more actual national government level, let's see. The first thing is to recognize that subsidizing bad pension products does not create consumer welfare. So we have these quite often where savings products, usually insurance-based, are then subsidized by the state, allegedly to benefit the consumers, but they are still sold through the inducement system. And these products are usually of so poor quality that they become unattractive even with the subsidies. And so then when the system doesn't work because people don't participate, and it's obvious that these products are of poor quality, then product providers often go to the national government and say, more subsidies, please, so we can raise the product quality. And this is a bottomless pit, because the money can sink forever, right? So what we need to do first is create a system where good products can be distributed into the market. It can be either through creating a better market, and then we're back to the whole advice thing, or it can be by circumventing the poor advice structure that we currently have and creating default systems and so forth with standardized minimum quality products. That is also a possibility. But also, from the consumer perspective, I have to mention that this is not entirely a financial market issue. As we've heard, half the population can't save. And so we need systems in place to cover these consumers as well, for whom the entire debate we're having today on how to invest and what market structures we need for retirement savings does not apply. And so either we need to cover them through social systems, or we need to address labor market policies and so forth. This would go far beyond the consumer organization's remit. but it is necessary, and it is the context in which this entire debate happens. So in summary, do that first, then stop blocking and start supporting European level initiatives that do transform the market for the better, and then open your own systems to either competition, or at least if you're not capable of doing that, then circumvent the swamp and create a feasible product which is possible to do for a government yourself.
Although maybe let me intervene and sort of link you to Nikolai. He sort of was saying, well, yeah, people need to have legs in order to run the marathon. And
Yes.
In Sweden, that is made possible by 18% going into a capital funded scheme. Now, a lot of EU countries, and you mentioned Germany, for example, you know, everything goes into a government-run system where basically it pays out to the current generation. So there is currently no capital backing of that. Is that something you would ask for?
I have no mandate to ask of a national government how to organize their Pillar 1. I do understand, of course, that some systems on the capital market may be more promising than others. But
it's a big debate in Germany. That's simply
I am aware of the debate. I'm also just trying not to wade into social politics debates.
Right,
but
right.
yeah, what I do know also in Germany is, for example, effectively consensus amongst financial markets experts, except those who benefit from the system, is that the Riester system, the subsidized pension system there, has failed catastrophically. Right, and that is exactly what I was talking about first, is that you cannot subsidize your way out of a bottomless pit. You need to create sensible structures. And so, yes, capital backing for a Pillar 1 system is a difficult transformation to make. It's certainly possible, but certainly, and then maybe also sensible to do. But the main point is that you need to find a system that will cover those parts of the population who have no financial legs, which is half, right? So this first, then the debate we had on capital market structures today.
Maybe Jan, because you also talked about the children, that's usually the point when people are starting to invest and they've missed the 10 years. Well, maybe that is because they didn't have the legs, so they didn't have the money. So how do you see that issue? What can governments do? What about Pillar 1? Should it be capital funded? Should countries sort of switch? Any view?
Well, I think we all agree that government-provided wheelchair doesn't solve the situation. We need to train to have our legs stronger. So let's work on this one. We do understand that in many countries, the Pillar 1 won't be the solution. However, after maybe 15 years of working on this pension report that Alexandra has mentioned, we know that there are clearly winners and there will be losers. Unfortunately, my country and my generation in Slovakia doesn't belong to winners. I would rather live in a pension system in Sweden because they have running 10% PA returns on their premium pensions, AP7 SAFA. So basically, I would like to copy that kind of system. However, let's be honest. We all know that local governments tend to protect their own systems because they believe in this kind of system, even if they are subsidized. The thing is that in order to improve the situation, we need, and honestly, with some good European solutions, we need a right to switch. please, I want to switch my pension savings from my dysfunctional scheme to another one that works. I would rather switch my savings to Sweden and use their kind of system, not the pillar one. I won't be a burden to the pillar one, but regarding the funded pensions, this is about investments. In most cases, it's global. So also in Slovakia, we have implemented under our recovery and resilience plan, we came to Sweden, we learned how to do it, we have implemented in Slovakia. So of course, the predefined options do work. So we are helping the people. If you don't know how to run, let me show you how to run. At least at the very beginning, I'll give you some predefined options. If you don't know how to run, just watch. And therefore, we have applied this predefined saving strategy until the age of 50. Everything is invested in passively managed equity funds. Then every single year we go down by 4 percentage points. Well, of course, until you reach everything in money markets, it's not the best strategy, but it really helps comparing what we have in Slovakia, that most of the pension savings were invested in a bond markets or money market funds. So this is one thing, right? To switch, showing them how to do it. It means some predefined options based on the research and maybe something modern. We know what works. We know that the PSD tool, what is concerning the saving accounts, helped improve the banking products and started the new market of creating apps where I have 4 banking accounts and now I'm able to manage my budget.
Yeah.
Do we have this kind of regulation for the financial products? So I'm able to download all my transaction and all my financial products in one app. And now I see how strong my legs are and financial health, because now I see all my assets, all my liabilities, and I know where am I, how strong am I, and what kind of strategy I need to implement to increase the level of assets, decrease the level of liabilities. So we need something like a financial service directive too, where we can interconnect all these kind of financial products. Suddenly, what will happen? We will be able to compare. This is not performing. This is performing better. I have to write a switch, and we don't need to regulate for better quality. The market will regulate itself. Of course, we will just show by certain benchmarks. This is the standard at this moment. You have better product than the standard, or you have below standard product, but still you have to write the switch. So this is what I would suggest for future years.
So I think you're making it a little bit, Brian mentioned competitiveness, and I think you're making a very holistic pitch on how competitiveness as maybe an add-on to the retail investment strategy in the next mandate could work. Alexandra, thinking about member states and the Swedish model, some reflections you said about Poland, would be simply interesting. What is maybe also the investor perspective, what's happening in Sweden, what's happening in other market, and you're doing the study that Jan is also participating in, which I always find very interesting.
Yes, well, yes, definitely. I mean, when you look at the study, when you look at the real returns that different pension savers in different countries can count on if they were retiring nowadays, I mean, the differences are pretty big, and unfortunately for most of the savers, the situation looks pretty bad. So whenever we are discussing and promoting our report, we were always trying to really a bit instigate the debate and make it worthwhile for member states and experts to really look at the countries where it works well and try to really understand why does it work so well. Because of course, we did already, we mentioned it in some events before together with Jan, it would be so much better, of course, to have a pension from Sweden than, for example, right now, I don't know, let's say in Slovakia. So we will be discussing this. I mentioned it already on Thursday. I'm still going to make a bit of publicity for Thursday, but on Thursday, really, we want to look at some country cases where it works well and where it actually doesn't work well. So we will be discussing Sweden, we will be discussing Netherlands, and we will be discussing as well France, to see a little bit what could be done. I think member states really have tools to make saving and investing more attractive to people. One very tool that is maybe underused for good purposes is, of course, taxation. You can make taxation as an investor incentive and not as a punishment. Taxation right now, I understand, is one also of the problems why PEP is not taking off. Not only the fee cap, which I think is unfortunately raised more and more often, pointing to the fact that the fee cap is one and only problem that we have with PEP, and I don't really necessarily agree with that. And also, as member states, you really need to think through what you are doing in a long time perspective. So in Poland, we had a reform of the whole pension system in 1999. And then the Polish government in 12-14 decided to seize like over 50 billion of privately run pension funds and transfer them back into the state control. So it was really a very sharp reversal of a reform that in the whole region of Central and Eastern Europe had, I think, really spillover effects, because Poland is, of course, a very big economy. And I think really a lot of discussion at the time was, if Poland cannot make it, I mean, who will? And of course, part of the justification for this sharp reversal of the reform was disappointing returns and really very high management fees. But also, one of the incentives to do it was for the government to be able to run a budget surplus. So it was not only about really saving people's money, you know. And I think right now you really see the effect of this in Poland. People are aware about the products they could be investing in, but of course they don't trust not only the products, but also they don't trust the government. They don't know right now ever when, if they start saving in those products, maybe this kind of thing will happen again. So I think really you need to think twice, or even better, 3 times, before any other government would try to do something like this, because a decade later you can see a very bad effect on the Polish society. And also about the equity culture. I think really we should look more into models like the Swedish one, when the equity culture is working. Because in Poland, as I mentioned, the study that was done this year, I mean, people were aware you can invest in stocks, you can invest in bonds, but less than 10% of the people that were surveyed in this study were aware about ETFs. And of course, this just confirms many other studies that were done, that simply they are not aware about ETFs because nobody really is advising them on the ETFs. So, and you cannot really buy something that you cannot see on the shelf, let's say. One last point that I would make: we talk a lot about financial education of retail investors, about the financial education for financial advisors, but really a lot of financial education is also needed for policymakers. And I think in many countries also capital markets are really completely demonized. So we can talk about the CMU, we can talk about like what many things we can do on an EU level, try to push it forward. If capital markets are demonized on a national level, we are not going to move forward really. And we can push as much as we can, the train here, but it will not arrive to capitals because there is like not enough appetite there.
Yeah, no, I think that is probably a very right statement. We have 6 minutes left. So I would say we go in the last round to simply reflect a bit about the next Commission mandate. And I think some of you have already started to do that, but I think this was a very interesting panel so far for me to really see what could be done on a national and European level. And maybe if you would put your best practice recommendations out in a minute or so, starting with Brian, Jan, Nikolai, and then Alexandra. Brian.
So next term will be a bit colored by whatever the outcome of the current risk proposal will be, which will obviously also run into that. I think we are going to have to, nobody wants to do this, and it's a bit masochistic to say, but I think we're going to have to reopen PRIPS fundamentally and rework that. I think there's also very wide agreement on that, even though there's very different ideas of what should be done to it. But I think in the current situation, everybody agrees that PRIPS do not work. And so that's going to be a fairly big priority. There's honestly, from a consumer perspective, there's also non-investment issues here. So we have an insurance problem with the capital markets union. We have payment systems issues and so forth. But on the investment side, I would actually keep the focus on the retail investment strategy and its follow-up, and then probably the PRIPS, and also interacting with the investment thing, also the sustainable finance reforms, because those, again, we're seeing exponential growth of green investment funds. Yeah, where is all the real economy backing that up? I'm a bit wondering how this miracle happened. So suddenly, with nobody noticing. So this is another issue, and it influences, of course, again, trust for consumers in also mainstream investment and so forth. So I think these will be probably the priorities. Single access point also for non-sustainability items. So this comes back again to proper market infrastructure, knowing what is out there, how it compares, having machine readable information also for academics to sift through, and for NGOs to find patterns and so forth. We have a huge problem with market transparency. Some of it has begun to be tackled this term. We will have to complete this process.
Yeah. Perfect. Jan?
Well, really shortly, as I have mentioned, government subsidized wheelchairs is not good for us, and therefore I'm a strong supporter for European solutions. I believe in sparring partners in the long runs. So I think the employers should be part of the process, opening the market for pay-ups, where the employers can bring their solutions that work in other countries to other companies or other partners in other countries, and help to grow really European solutions. This is what I see as a potentially bright future for all the savers. And from a consumer perspective, I really do believe that we will also open the market for some disruptive technologies, as I have mentioned, for the Financial Services Directive 2, where I will be able to see all my financial products on one place, able to compare it. Of course, this really requires some work on transparency and disclosure issues. However, my financial data are my financial data, and the financial products I buy, I want to see the full disclosure of all the elements.
All elements. Nikolai.
Yes.
Wish list.
Yes, wish list. Yeah. So again, a little bit of a luxury for me, because we don't have a very, very long wish list. But we do want to say that we believe that it's important that this is not necessarily done through regulation. Pension and retail is by nature something that is local. But obviously, we're convinced that the Commission can play a very important role in pushing national measures, sharing best and worst practices. So pension schemes changes through a directive or even EU law need to be slowly phased in, as you don't want to bankrupt the country. So suddenly, imposing companies to pay 10% into pensions and force people to save might have dire consequences for the economy, short to medium term. So I wouldn't propose any policy measures, but rather use recommendations and opinions. There is plenty of influencing that the Commission can do beside regulation, similar to their recommendation on facilitating finance for the transition to a sustainable economy. Financial literacy, as an example, is a good way to start, i.e. enlightening the electorate. And I think we also need to not only talk about the Commission's role or EU in general's role, but talk about the bank's role. I am a strong believer in the banks needing to take more responsibility. They sit right at the center of people's personal finances, like Jan mentioned previously. So when it comes to financial literacy, the bank should take a much bigger role going forward when it comes to educating the electorate.
Very well. No, very clear and from a good position, as you said. Alexandra.
Yes, I'm always a bit skeptical about financial education being done by the financial representatives, financial stakeholders. But I would say, like, my really big ask would be, since consumers and investors are quite often like really left behind to themselves by the national governments, to have finally like the EU authority really on consumer protection and conduct of business. So the one that would really have those two as the center of the mandate, I would be really caring for that. For national governments, I would also say national supervisors, regulators, just also start better maybe enforcing what you could already start enforcing, and take maybe, emulate some of the really good supervisors that are doing their jobs, like the ones, let's say, I don't know, in the like the FCA, that they have really quite good ideas, and they are, even sometimes if they are doing only soft laws, they're sometimes really working well. So maybe worth taking a look at what they are doing there. And for the European Commission, I would just say, like, keep up the work on the value for money and tackling conflicts of interest, and it's going to probably improve the situation for the investors, hopefully sooner than later.
Hopefully sooner than later. No, but I thought it was an extremely interesting panel. I compliments to all my panelists, and thank you very much for participating. I think to me, what really keeps sticking, trust is important. I think the Swedes have created that trust. The Polish example is one how you can lose trust, and obviously trust in that your pension will actually pay some money out, beat inflation, be competitive. I think we heard a lot from Brian and Jan around competitiveness. I think that is something important we need to instill. And certainly coming back to what Alexandra said and Nikolai with his example, putting savings to use. I mean, Europe cannot afford not to make use of all the household savings we do have that are invested extremely inefficiently today. We need them to bear yield for citizens to save for pensions and to have a good return on their investment. But at the same time, and I think the case of the Nordics is quite impressive, that also means job creation, wealth creation, and innovation, and that we have an economy that works. So certainly an economy that works for the people, as the Commission says, is something that we need to get to. And this question of capital market union and retirement is, I think, a very important one. Thank you, everybody. I found it very, very interesting for myself. It was fun moderating, and I wish all of you a successful day. Thank you.
Thank you.
Bye-bye.
Bye.
Thank you. Bye.